Well, we're really stealing share from the big banks. And so we've been able to add more than $2 billion of deposits in each quarter since getting our bank license. And when we reported in Q2, we remain confident that we could add $2 billion plus each quarter, and we're on track to do that.
If you didn't catch that, SoFi CEO Anthony Noto just said that SoFi is taking market share away from the big banks and that more and more customers are depositing their money into SoFi. Not many people understand the significance of what CEO Anthony Noto just said, so in today's video, I will try to explain the implications of what he just said in his recent interview as well as what it means for investors today. But before we do that, let's quickly take a look at SoFi's Q2 results. By the way, I wrote an article on SoFi, so if you prefer reading this analysis, you can find the link to my article in the description box below. So Q2 results. Q2 GAAP revenue was $498 million, which is up 37% year over year, and growth was primarily due to strength in all three segments of SoFi's business, namely lending, tech platform, and financial services. As you can see, growth has decelerated meaningfully over the last few quarters, but considering that SoFi is growing over a much larger base, a 30% plus growth is still very impressive in my opinion. Here you can see how revenue is broken down by segment. The lending segment is SoFi's bread and butter, generating 67% of revenue in Q2, and as of Q2, lending revenue was $331 million, which is up 29% year over year. As you can see, the lending segment has been posting 30% plus growth over the last few quarters, despite the student loans business experiencing a major slowdown due to the student loan moratorium. Moving on to the next business unit, Q2 revenue from tech platform, which consists of Galileo and Thesis, was $88 million, which is up only 4% year over year. Growth for the segment was due to the additions of new clients and growth at existing clients, but as you can see, there's a sharp deceleration in the last few quarters, and this is mainly due to slowing account growth, which only grew by 11% in Q2 to 129 million total accounts. While growth in the segment may look discouraging at the moment, management mentioned that tech platform revenue should re-accelerate in Q4, which is great to hear. Last but not least, we have the financial services segment, which produced $98 million of revenue in Q2, up a staggering 223% year over year. The hypergrowth is due to three reasons. The first reason is strong member growth across the platform, with Q2 members growing 44% year over year to 6.2 million, adding a record 584,000 members in a single quarter. The second reason is cross-buy, whereby total financial services products grew 47% year over year to 7.9 million, adding 759,000 products quarter over quarter, which is more than the number of new members added, which means that each individual member on average is using more products on SoFi's platform. And the third reason for the growth in the financial services segment is better monetization, with revenue per financial services product doubling year over year to $50. So overall, the lending segment looks okay, the tech platform looks weak, and the financial services segment looks solid. But let me talk more about the lending segment specifically. Here you can see loan originations by segment as well as total loan volumes. As you can see, personal loans is the clear outperformer here, with 50% plus growth over the last few quarters, and in Q2, personal loans was $3.7 billion, which is up 51% year over year. On the other hand, home loans and student loans are not doing very well, with negative growth over the last few quarters, as you can see right here. In Q2, home loan volumes was down 27% year over year to $243 million, and while it is still far below 2020 and 2021 levels, notice that home loans tripled sequentially from Q1 to Q2, and this is due to increased capacity and capabilities as SoFi fully integrates Wyndham Capital Mortgage, which it acquired back in April this year. So home loan volumes should improve moving forward. As for student loans, volumes are down significantly from 2019 levels, as you can see right here, due to the student loan moratorium, with Q2 volumes of about $400 million, which is pretty much flat year over year. However, the moratorium came to an end recently, with student loan payments expected to resume this coming October. As such, student loan originations should pick up once again, as borrowers would want to refinance at a lower rate or extend the loan term. Overall though, total loan loan originations was $4.3 billion in Q2, which is up 37% year over year, which is a re-acceleration from Q1. All in all, SoFi is showing really strong growth, and while growth is slowing down, growth is expected to remain robust in the next few quarters due to the end of the student loan moratorium, increased capacity to originate home loans, as well as a strong pipeline within the tech platform segment. More importantly, SoFi is taking market share, but not just any market share, it's market share from the top 5 banks. This is important because it's confirmation of SoFi's superior value proposition as a digital bank, and that alone means that SoFi still has a long growth runway ahead. Turning to profitability, overall contribution profit, which is net revenue minus direct expenses, was $196 million in Q2, representing a 40% margin to adjusted net revenue. Although contribution margin dipped slightly quarter over quarter, it is still an improvement from last year's 31% contribution margin, which shows economies of scale within SoFi's platform. Here we can see contribution margins by segment. For the lending segment, contribution margin was 57% in Q2, and despite being flat year over year and lower quarter over quarter, the lending segment could one day have contribution margins as high as 70%, as mentioned by the CEO in a recent conference. It's not there yet, but perhaps some of its loans are generating that high of a contribution margin, which is probably why CEO Anthony Noto mentioned that 70% figure. Next, tech platform contribution margin was 20% in Q2, which was a decline from last year's 26% contribution margin due to the acquisition of Thesis, which has a lower margin profile. That said, it is a slight improvement from the prior quarter, so hopefully that trend continues. And finally, the financial services segment is still operating at a loss with a contribution margin of -4%, as you can see right here. However, it is a major improvement from last year's -177% margin and last quarter's -30% margin. This is due to efficiency gains as the segment scales further, and judging by the trend, it won't be surprising to see the financial services segment achieve positive contribution profit in Q3. Also of important note, SoFi is gaining operating leverage as all expense lines as a percentage of revenue continues to fall, as mentioned by the CFO. In Q2, SoFi recorded a GAAP net loss of $48 million, and although net margins dipped slightly quarter over quarter from -7% to -10%, it is still a material improvement from last year's Q2 net margin of -26%, which is great to see. In my opinion, SoFi's overall bottom line should improve significantly over the next few quarters as the company continues to gain operating leverage as well as benefit from the recovery of its high margin student loan business following the end of the moratorium. With that said, SoFi is on track to be GAAP net income profitable by the end of the year, which I think is going to be a major catalyst for the stock. Turning to the balance sheet, SoFi has cash in hand of about $3 billion with a total debt of about $6.6 billion, which puts its net cash position to be about -$3.6 billion, which is pretty much flat quarter over quarter. Here you can see how SoFi's loans, deposits, and debt balance have trended over time. As you can see, customer deposits have been growing, which is what we want to see happening over time, and this is important because SoFi can use customer deposits to fund its loan portfolio, which has a lower cost of capital than using debt. As of Q2, SoFi has $18.6 billion of loans in its balance sheet with $12.7 billion of customer deposits, and CEO Anthony Noto is super confident of adding $2 billion of customer deposits each quarter. As deposits grow, so should its loan portfolio, and this will boost financial services and lending revenue as SoFi's balance sheet continues to expand. In terms of cash flow, I'm using adjusted EBITDA since it's a good proxy for free cash flow, and as you can see, adjusted EBITDA is positive and is improving over the last few quarters. In Q2, adjusted EBITDA was $77 million at a 15% margin, which indicates that SoFi is cash flow positive. In other words, SoFi looks very solid from a balance sheet and cash flow perspective. Turning to outlook, management provided the following guidance, and keep in mind that I will only be looking at the high end of management's guidance since SoFi always beats its own guidance. That said, second half adjusted net revenue is expected to be about $1.085 billion, which is up 26% year over year, and second half adjusted EBITDA is expected to be $190 million, which is an 18% EBITDA margin, which, as you can recall, it is an improvement from Q2's 15% margin, which is good to see. Management also raised their full year guidance, as they always do, with full year 2023 adjusted net revenue to be about $2 billion, which is up 32% year over year, and full year adjusted EBITDA is expected to be about $343 million at a 17% adjusted EBITDA margin. All in all, strong guidance by management, as SoFi posted another beat and raise quarter, which is a testament to the company's value proposition and execution. In addition, for adjusted EBITDA, management also expects an incremental adjusted EBITDA margin of about 44%. And for those who are unaware, incremental adjusted EBITDA margin is equal to the change in adjusted EBITDA divided by the change in net revenue. So with an incremental adjusted EBITDA margin of 44%, for every additional $100 million of revenue that SoFi generates, the company subsequently produces $44 million of adjusted EBITDA. This is a very important metric because it tells us about the long-term margin profile of SoFi as a business, and CEO Anthony Noto is very confident that the company can achieve a long-term adjusted EBITDA margin of 30%, which is great to hear. In addition, Anthony Noto expects an ROE of at least 30% once the company reaches a $1 billion of net operating profit, and he also mentioned that ROE is already well in excess of 35%. If what he said is true, that SoFi could reach an ROE of 30%, then SoFi could become the most profitable bank in the US with far superior ROE figures than legacy banks, as you can see here, so that is something to be excited about. Turning to valuation, we can see that SoFi has traded as high as 38.9 times its revenue. However, valuation has now collapsed to just 6 times its revenue, which is a significant discount based on historical standards, and is also close to its all-time multiple lows of about 4.9 times. If we compare SoFi's valuation with the major banks, we can see that SoFi has a price to tangible book ratio of about 2.3 times, which is a large premium to the major banks like JP Morgan and Wells Fargo, but this is well justified since SoFi is growing multiple times faster than these banks. If we head to Seeking Alpha, we can see that analysts have an average price target of about $10.44 for SoFi, which represents an upside of 38%, so that is pretty decent returns for investors. But going back to the intro of the video, CEO Anthony Noto mentioned that the company is taking market share from the big banks, and this is important because it's confirmation that SoFi is the future of banking. And during the earnings call, he also mentioned that SoFi will one day become a top 10 financial institution by market cap. With that in mind, if we look at the list of largest banks by market cap, we can see that the 10th largest bank by market cap is Morgan Stanley, which is valued at $138 billion. So based on SoFi's current market cap of $7 billion, taking position number 10 would mean an almost 20x increase in SoFi's market cap. And judging by SoFi's financial performance over the last few quarters, I think it's only a matter of time before SoFi become a top 10 financial institution. I think that will take at least a decade, but a 20x return on investment in a decade is very good, and that alone is the ultimate bull thesis for SoFi. So wrapping up this video, my investment thesis on SoFi is that the company is disrupting the entire banking industry through its all-in-one financial platform. The company is growing rapidly and is turning GAAP profitable, and the end of the student loan moratorium means that growth could re-accelerate in the next few quarters as the company continues to build its balance sheet. More importantly, SoFi is taking market share from the big banks, which is a clear indication that the road to being a top 10 financial institution is well underway. The biggest risk for SoFi stock is that it seems to be driven by monetary policy and regulations, which is unpredictable, so expect a lot of volatility moving forward. That said, I still think there's massive potential for SoFi, which is why I'm considering starting a position in SoFi very soon. But what about you guys? What do you think about SoFi stock? Please let me know in the comment section down below. Otherwise, that's all that I have for you today. If you like this video or if you find value in this video, please leave a like and comment and subscribe to my channel for more investment content like this. As always, I appreciate you guys and I hope you have an amazing day. See you guys on the next one.